Another rule that you guys get a lot of questions about and there's a lot of confusion about with these Roth accounts is the 5-year rule. And Clint, you are here to help us make it very crystal clear for everyone.
I am. It is sometimes hard to follow, so we're going to walk through a few examples that helps to illustrate some of the 5-year rules that are in play when it comes to how long you've had your Roth IRA open. So what we'll look at for this example is there's an individual who has a Roth IRA, current balance of $30,000. Now, not every dollar is equal there. We're going to show in this particular example that this family has made $20,000 worth of contributions, and then $10,000 of that account is earnings or growth that they've had since they've made those contributions. And again, that adds up to the $30,000 total balance in this individual's Roth IRA. Now, if they wanted to get at that full amount, if the individual said, hey, I want to take all $30,000 out, and they are above 59.5, and their Roth IRA has been opened, established for longer than 5 years or longer, then they can take the entire $30,000 out, all the growth and all of their contributions without any sort of penalty or any sort of taxation. And so that's a particular case for someone who's 59.5 or older, and they have satisfied that 5-year rule for Roth IRA and how long that has been open. Look at this example. If the individual is 59.5, so they've checked that box, but their Roth IRA has not been open for 5 years, well, then now they start to have a different outlook. They can always get their contributions back without any sort of tax or penalty, but what they would find is that there will be taxation at their earned income rate on the growth that has occurred in their account since they've made those contributions. And in this particular case, it's an individual who is 59.5, but their Roth IRA has not satisfied the 5-year rule for how long it's been in existence. Last example, this is an individual who is less than 59.5, and their Roth IRA has not satisfied the 5-year rule. It has not been open for a full 5 years. In this particular case, if this individual came to us and they said, hey, I want to take my entire balance out, well, they'd have a really interesting situation. They would find that their growth in their account would be taxed, and they would also be facing a 10% penalty, which is really an early distribution penalty. So they can always get their contributions, the $20,000 back, but the growth would be taxed, and they would have a penalty on that if they have not satisfied the 5-year rule and they are less than 59.5. So this just gets to that importance of, we know Roth IRAs are important, but we also need to have a larger plan in mind as to what they're doing, and then when they might want to be taking some of these dollars out.
Those rules are really important to understand, and I think it's important to understand the two main criteria. One is has the Roth IRA been open for 5 years, and the other one 59.5. Any contributions that you make to your Roth, regardless of those two criteria, your contributions you can take out at any time, not have to pay taxes and not have to pay penalties. So what we're talking about then is the earnings. And that first criteria of, has the Roth IRA been open for 5 years, that could be any Roth IRA. So if you put $1 into a Roth IRA 10 years ago, haven't contributed since, and then this year you put $8,000 into your Roth, well, that $8,000 has met that 5-year rule because it goes back to your very first contribution. And that's an important note. But one of the most important aspects of all of this is, as you're looking to use the Roth IRA in any capacity, have the end plan in mind. Understand, here's directionally how you're going to use this Roth. Here's the time frame that you can afford to have these monies invested to make sure that whenever you do take it out, you're not going to have that penalty or pay taxes on any of the earnings.
And I think, go ahead.
Yeah, no, another thing to note, and this is where it gets complex. It gets to the importance of working with a trusted professional to make sure you understand all the rules and how that might apply in your situation, is a lot of families are starting to contribute to the Roth side of their 401k now. And that does not count towards that Roth IRA 5-year rule. So they could have been contributing to their Roth IRA or their Roth 401k for 5 years, 10 years, whatever it may be. That is not starting the clock on their Roth IRA 5-year rule.
And what's really interesting to me about the 5-year rule is it's not really 5 years. They don't count a year. When I say they, the government, IRS, who makes these rules, they don't count a year as 365 days. They just count it as the year that you start the account. So you could start at December 31st and you've got a year under your belt, correct?
Yeah, what they're counting is the tax year. So if your contribution, if you can count that, let's say your contribution, you can count it towards tax year 2024, even though you actually contributed to that Roth in March of 2025, well, 2024 starts, and then of course 2025 starts, but 2024 would be the first year that you can count for that. So it doesn't have to be a full 5 years from your contribution. It goes by tax years.
And they could also take it out January 1st of that 5th year. They wouldn't have to wait through the end of that calendar year.
Now it's time, Clint, to talk about conversions.
Yeah, so let's go to the board, look at another example to help understand that a little bit better. And as we start to think about completing a Roth conversion, what we find is that begins a 5-year clock on the conversion amount, and we have to pay attention to that as we think about what we might want to do for distributions from our Roth IRA. In this example, we're looking at a $50,000 Roth IRA, of which $40,000 has been converted into this, and there has been growth received on the conversion amount of $10,000. The 40 and the 10 adds up to the $50,000 Roth IRA for this individual. Now, if this individual came to us and they said, hey, I want to take the entire $50,000 out and use for whatever it may be as part of their retirement lifestyle, what we would want to think about is there going to be any sort of tax or penalty? And if they are 59 and a half, even if it's been less than 5 years since they have done the Roth conversion, they still will be able to get to that full amount that they've converted, as well as any growth that they've received on that account without any sort of tax or any sort of penalty on that. So those dollars are free and clear, in large part because this family or this particular individual is 59 and a half or older, and that's the purpose of that Roth IRA, is to be utilizing those assets in retirement. There are no rules that are going to limit them. If this particular individual was in a different situation, and now their example here is that they are less than 59 and a half, and it's been less than 5 years since they have made this Roth conversion of $40,000. We see again, they've got $40,000 that was converted. Since they've done that, they've received $10,000 of growth. If they wanted to get to that full $50,000 balance, take it all out, they need to be very intentional and make sure that that's going to be a good part of their plan, because they're actually going to receive taxation at their earned income rate on the growth that has occurred within this account since they did the conversion. And just as important, they're also going to have a 10% penalty, not just on the growth, but on the full amount that they have converted. And really, in the eyes of the IRS, they have taken a premature IRA distribution. Even though they've converted it to the Roth, they would have a penalty to take out that full $50,000. And so when we start to help families through the idea behind a Roth conversion, does it make sense or not? These are things that we want to be thinking about. When do we anticipate using these dollars, and what's the best way to do it so that you're not going to receive some sort of tax or penalty that you are not anticipating?
So I think people are probably starting to take away that we could do a 3-hour show on Roth IRAs and the rules around contributions and conversions, because there's just so much that goes into it. I would say, to kind of summarize this, there's probably 2 main things that people can do to help with all of these rules. One is start a Roth IRA soon. The sooner the better, because it gets that original 5-year rule started. And then after the 5 years that you start that Roth IRA, that's one big hurdle that you don't have to worry about anymore. So even if it's a $10, a $1 contribution to a Roth IRA, get the 5-year clock started. That can help you make these rules a little bit easier. And then the second one is, with any Roth contribution or Roth conversion, having a plan in place that is more than just your contribution or conversion plan. How's it going to impact your income plan in retirement? How's it going to impact your tax plan and your legacy plan? How's it going to impact all of those? And once you have that in place, then your confidence level on your contributions and your conversions is going to skyrocket, because you know exactly why you're doing what you're doing and how it's going to impact you short and long term. Those are probably the 2 biggest takeaways.